Let's come back. Previously, I've said bond risks come from its return. So, in order to understand the relationship between bonds return and risk, we have this figure. And we start to analyze the return of a bond. In this way, we can also understand the risk of bond. There are two sources for bond return. The first source is bonds interest. This part we call coupon interest. Coupon interest of a bond. This is the primary source of bond return. However, we have another source of return for a bond, which is the capital gain. The capital gain means gain or loss by the changes of bond prices. Let's explain the capital gain in another way. For example, we have a bond. We have a bond A here. And bond could be tradable in market. For example, in day one, we have a bond price which is, for example, 101. Day two, we have the price of the same bond which is 102. The capital gain here is 102 minus 101. We have 1. We have 1 RMB. So this is called capital gain. Although it is called capital gain, but sometimes the price may not be favorable for us. For example, in day 2, the bond price may be 99. And then our capital gain is 99 minus 1, or 101. And our capital gain is minus 1. So in such situations, we call it a capital loss. It's a capital loss. In this way, the capital gain is a neutral word as well. It has two aspects. The first one is we have a positive gain. Another one, we have a negative gain. Okay, so this is the capital gain. And capital gain is the gain or loss we trade bonds in market. Here, these are the two sources of bond return. Accordingly, we have two sources of bond risks. Let's look at from bonds interest. Although bond issuers promise to pay investors coupon interest, but we may have a credit risk. Credit risk means bond issuer refuse to pay us coupon interest. Even they refuse to pay investors principal at maturity. Refuse to repay interest and principal back to investors. These kind of things is called a default. Okay. So this kind of risk is the most important, the most critical risk in bond investment. Critical risk. In this way, investors lose everything. So this is a risk. And then we look at capital gain. Capital gain comes from the changes of bond price in market. And there are two sides as well. We may have a positive capital gain, or we may have a negative, which is called capital loss. So this is another kind of risk comes from capital gain. In this way, we have the two major sources of risks for bonds. Next, let's look at the pros and cons of bond investment. Here, pros and cons means advantage and disadvantages. Advantages and disadvantages. Now let's look at one by one. For a bond, the first advantage is investors receive income through the interest payments. This is relatively fixed. In this way, we think that bond investment is less risky compared to stock. Disadvantage: bonds pays out lower returns compared to stocks. Why? Stocks pays stock dividend. If stock issuer pay dividends, usually it is relatively higher. However, stock issuers may not pay dividends. The second part of the advantage of a bond is if an investor holds the bonds to maturity, the investor could get back all principals. Here, principals means bonds face value, also called par value. Disadvantage: companies may default on our bonds. Default, again, I repeat, means company fails to pay back, fails to repay. Third point: for bond investors, if they resell the bond at a higher price in market, investors could earn profits. So this is called capital gain. Suppose we have a positive capital gain. Its disadvantage: bonds yields can fall, means downwards. So for bonds, we have primarily 3 points of advantages, and accordingly we have 3 aspects of disadvantages, which is connected to each part of advantages. Now let's look at another real bonds. This is called the Commonwealth of Australia. Well, this is the official name of Australia, the country's name. So why we call it Commonwealth? Here, Commonwealth means Australian respect to the Queens of UK, maybe King as well. So this also means Australia is not an independent nation in respect to UK King or Queen. And these bonds issued by Australian government, so it is a Australian treasury bonds. Its face value is 20 Australian dollars. Face value. Par value as well. Its interest is 5.25%. This usually refers to annual rate or annual interest rate. So this is a bond, and it is issued in 1987. There are also other clauses here. Next, we will talk about the elements of a bond. Okay. The first element of a bond is its face value. A bond's face value is usually printed on the face of a bond, so that's why it is called a face value. And in many countries, they also call that a par value. In China, the face value of a bond is usually 100 RMB or sometimes 1,000 RMB. This is also called the principal of a bond. Face value is the money amount the bond will be worth at maturity. The face value is also the base for bond to calculate interest payments. For example, if a bond, its face value is 100 RMB and its coupon rate is 5%, then the annual interest would be 100 times 5% equals 5 RMB. Here, 5% is called the coupon interest rate, or simply coupon rate, and this is called coupon interest. Coupon interest. Next is the coupon rate or coupon interest rate. It is the rate of interest that bond issuer will pay depends or based on the face value. It is expressed as a percentage. It's a percentage. But the complicated thing is the coupon interest rate usually refers to annual interest rate. Annual interest rate. And a bond may pay interest 1 time or 2 times a year, or even 4 times a year. So each time the interest rate is actually, say for example, the annual interest rate is 5%. If they pay 1 time interest a year, the interest rate is 5%. If they pay 2 times a year, every time the interest rate is 5% divided by 2, which is 2.5%. If they pay 4 times interest a year, each time the interest rate is 5% divided by 4, which is 1.25%. So this is the coupon rate. And coupon rate is a key factor that determines the bond price in market. Bond price in market. And we will have further discussions on interest rate later in this module. Now we have a bond. Face value, suppose $1,000. Coupon rate 5%. Maturity 10 years. Suppose the investor paid $1,000 for the bond. The investor will receive $50 per year in interest payment. How do we get the $50? Which is $1,000 times 5% equals to $50. At the end of the 10 years, which means at maturity, the investor will get the face value back, which is $1,000 US. In this way, we can quickly draw the cash flows of a bond in the future. Okay. At this time point, investors pay $1,000 to purchase a bond. So in terms of cash flow here is minus $1,000. And then at the first year, the investor gets $50. The second year, $50. First year, second year, until the 10th years, $50, right? $50. Here is the maturity. At maturity, investors receive not only $50 as the interest, but also its face value back, which is $1,000. So this is the cash flow of a bond in the future. However, we have problems to calculate gain or loss because the $50 or $1,000 after 10 years, their value are different from the same amount of dollar at this year. So we call this 0 points. It's different. In order to calculate our investment value, we have to discount all the future cash flows back to the time point we purchased the bond. That means we have to discount the $50 back here, and we have to discount the $50 back here, and all the way back. In this way, we can calculate a value called present value. Present value of the future cash flows. Future cash flows. Who knows how to calculate future cash flows back to current point? Yes, we have a very simple equation on that. For the first year, $50, how do we calculate back? Or in other words, how do we discount the $50 in the first year back to the time point we purchased the bond? We use this way. the coupon rate is 5%. Suppose the coupon rate is the same as the market rate. We have an assumption here. It's 1 plus 5%, right? Second year, $50. 1 plus 5%, we have a square pound. And the 10 years, we have $50 plus $1,000. And then divided by 1 plus 5%, 10th power. After that, we make a lump sum. We make a lump sum of all these discounted value together so that we can have an investment value in our bond investments. And then we need to compare with our initial investments, which is $1,000. If the lump sum is, suppose, $1,050, then we will have investment earnings $50. 1,050 minus 1,000. However, if the result of the lump sum is $970, then we will have an investment loss, which is $30 minus $30 equals to 970 minus 1,000. So we have a new concept called present value. In short, we call it PV, present value. This represents a very important concept in bond investment. We say that our long-term investment has a time value. That means $1 now, or 1 RMB now, should worth more than 1 RMB in the future. For example, the first year, 1.05. The second year should be 1 times 1 plus 5% squared, and so on. From the other side, 1 RMB in the future should worth less for now. Say this is after 10 years. It should be 1 RMB, 1 plus 5%, 10th power. This means 1 RMB in the future worth less for now. It is definitely less than 1 RMB for 1 RMB in the future. So this concept is called the time value. So this is very different of bond compared with stock. Then let's look at other elements of a bond. Coupon dates. Coupon dates are the dates when bond issuer should make interest payment, should pay. So at coupon dates, investors should receive coupon interest. Then maturity date. Maturity date is the date when bond issuer should pay back the bondholder the face value, and the bond expires. Now, we have the issue price. The issue price is a very different from the other elements of a bond. Let's look at issue price. Bond's issue price. Bond issue price is bond issuer sells its bonds in market at this price. We have 3 situations here. The first situation, suppose the bond, its face value is 100 RMB. First situation is a bond issuer may sell its bonds in market at a price, say 105, or just 100, or 97. In this case, we call this bond as a premium bond. A premium bond means the bond's issue price is higher than its face value. This we call this a flat bond, and this we call this a discount bond. Okay. A discount bond means a bond issuer sell its bonds in market at a price less than its face value. Okay. These three situations depends on the relationship of coupon interest rate as well as the market interest rate. Based on the relationship between coupon rate and market interest rate. Let's do this. If coupon rate is higher than market interest rate, then the bond will be a premium bond. If coupon rate equals to market interest rate, it would be a flat bond. If coupon rate is less than market interest rate, or even no coupon rate, that means coupon rate is 0, then the bond would be a discount bond. So these are the three situations of bond issue price. This is the topic of this types of bond. The question here is, what are the types of bonds? Here we mean standard types or traditional types. So traditionally we have three major types of bonds. First of all is treasury bonds. A treasury bonds is issued by the central government. Of a country or a region. And municipality bonds, also issued by governments, but not the central governments, local governments. In China, it could be provincial governments. It could be city governments. Provincial governments or city governments. And then we have corporate bonds. Corporate bonds issued by commercial companies. In China, I have said previously, we have two kinds of that. One is called enterprise bond. Another is called corporate bonds. Enterprise bond issued by SOE companies. And the other type of corporate bonds issued by commercial companies. These are the three major types of bonds from the perspective of different issuers. For treasury bonds, just as I previously said, there were different treasury bonds as well in terms of the length of maturity. For those bonds, its maturity is less than 1 year or 1 year. 1 year or less than 1 year to maturity. They are called bills. So treasury bills. Sometimes we use T-bills. T refers to treasury. And for those treasury bonds, their maturity is from 1 to 10 years. We call them notes. T notes. Here T refers to treasury. And for those bonds, their maturity is more than 10 years. We call them bonds. So this is called T-bonds. So besides T-bills, T-notes, and T-bonds, we also have another name called sovereign debt or sovereign bonds. That means a sovereign debt or a sovereign bonds issued by a nation's government in foreign currency and sold to foreign investors. In this way, this bond is called a sovereign bond. For example, Chinese governments issue US dollar bonds in Hong Kong and sold to foreign investors. So these bonds from the perspective of foreign investors, they are sovereign debts or sovereign bonds. Investors buy sovereign bonds based on a country or a region's credit. A country or a region's national credit. Usually, a national credit is highly reliable. It's less risky. It's less risky. Because this kind of bonds is endorsed by the central government of a nation. Endorsed by the credit of a country. Usually it's less risky, but there are exceptions, such as many years ago, Greek government. They saw lots of sovereign bonds. However, when these bonds got matured, Greek governments was not able to repay the interest and the principal. In this way, we have the Greek bond crisis. Greek bond crisis. Recently, we have Sri Lanka. Sri Lanka government also saw lots of sovereign bonds to foreign investors, including many investors in China. And recently, Sri Lanka government refused governmental bankruptcy. Governmental bankruptcy. This means Sri Lanka governments will not repay the interest and the principals of these bonds at maturity, at least not now. This also means the bankruptcy of a government's credit. Bankruptcy of a government's credit. In this sense, sovereign bonds investors will suffer great loss. Municipal governments by provincial, states, and municipalities means city governments. There is a special feature for municipal bonds. Usually it offers a tax-free coupon. Let me explain the tax-free here. The tax related to a bond, usually we have two parts. First one is called the national tax. National tax. And then local tax. National tax refers to the tax collected by central governments. The local tax collected by local governments. The tax-free here refers to only this part, not this part. We have to be aware about this. Corporate bonds. For corporate bonds, in other countries like in US, Japan, Korea, Singapore, Hong Kong, there were only one type of corporate bonds. But in China, we have two types. First one we call enterprise bonds issued by state-run companies, and they are usually traded at IBBM. IBBM means interbank bond market. Another one, company bonds, commercial bonds. They are usually traded in EBM, exchange bond markets. We will explain interbank bond market and exchange bond markets later in this module. In this topic, we will study some of the special type of bonds. They are very special. Let's look at the first one. Zero coupon bonds. Zero coupon bonds. Zero coupon bonds means their coupon rate is zero. You may be curious and have a question. How come zero coupon bonds could be sold to investors? Why investors buy zero coupon bonds? Okay, this is a very interesting question. Let me explain. zero coupon bonds. The question is, why investors buy zero coupon bonds? Zero coupon bonds means investors will not receive any of coupon interest. Coupon interest. Absolutely no. Previously, we have said that there are two sources of bond returns. Two sources of bond returns. One is from coupon interest. Another is from capital gain. For zero coupon bonds, there is no coupon interest. So the only source of return is capital gain. So the question is, if we issue zero coupon bonds, how can we sell our zero coupon bonds to investors? The secret is issue price. Say, for example, we sell a zero coupon bonds which face value is 100 RMB. In order to sell it out, we can set the issue price of this bond is, for example, 85 RMB. It's far below its values. That means investors only pay 85 RMB to a bond which face value is 100 RMB. This means, let's look at its cash flow. Okay. Investors pay 100 RMB. The cash flow here is minus. However, at maturity, investor will receive the bond's face value, which is 100 RMB. This is positive. So the determining factor is after we discount back the face value of a bond, we will compare with the issue price. If the discount of 100 RMB, say for example, this is a 2-year bonds, and suppose the market interest rate is 5%, then we can quickly calculate this way: 100 divided by 5% square. This is the present value. Then we will compare with what? With 85. If the PEV is bigger than 85, it is still worthwhile for investors to invest. If the PEV is less than 85, I believe smart investors will not buy this bond. So this is why investors buy zero coupon bonds. The secret, I repeat, is the issue price. We have to set a lower issue price, much lower than the bond's face value, so that we let the investor realize that they could still earn something from the lower issue price, even we discount back the future received face value. This is zero coupon bonds. For example, the US Treasury bills, the T-bills, are typical zero coupon bonds. Another interesting variety of bond is called convertible bonds. So convertible bonds is always a hot topic in market. A convertible bonds is a debt instrument. Okay, all bonds are debt instrument. However, it is not a traditional bond. It has an option embedded inside this bond. The option allows bondholders to convert their debt or bond into stock. Of course, under some conditions and at some time points. I'll explain further after the break. Let's have a 10 minutes break. Let's get back at 9:50.